Hello and welcome everybody to the Middle Class Investor. This is Seth Martin. It is March 26th. Today is my daughter's birthday, 15th birthday. So we've been celebrating with her. Well, the markets have finally started to pull back. I haven't been here for a couple of weeks, mainly for a couple of reasons. One, there was nothing new happening in the market, and two, I've been busy traveling and doing some other things, so I just haven't gotten around to making a video. Apologize. I hope it hasn't caused anybody too much inconvenience. So anyway, the S&P 500 this week was down, as you can see here on the screen, and I think the thing to point out here, let me get this centered right. I think the thing to point out here, there's this little trend within this larger trend, and I'll show you the larger trend in a second. But you can see the channel lines that I've drawn here, and you can see that the market is basically pulled back to that channel line. And maybe it pulls back a little bit further next week. Maybe I've got the channel line drawn too narrowly. As you can see, this went over, but maybe a better spot is down just slightly lower here. But I think in this shorter little trend right through here, so I'm talking about all this price action right here, this pullback is either done or nearly done. Maybe it's got to pull back a little bit further, and then we should see some move up above this high here. Not a significant move above the high, but just a little bit higher. And then we should, from there, I think, get a deeper pullback, something that takes us back something around this 2250 area, 2260. And so that's what I'm looking for. But I think this little pullback is going to be just that little. The market does this. It gets you to thinking, boy, I wish I'd have gotten in here, as it makes a new high. Well, then it pulls back even further, and you're like, whew, I'm glad I didn't get in there. I mean, it's a very monotonous process, trying to follow the markets. But essentially, what you have here is this whole thing starting back here is the major trend. So let's see if we can. I don't know if I can get it all on one page here. Maybe. Yeah, more or less. So starting here, this is the major trend, and so let me just draw it here. You got this kind of up and then down, and then this is really all one move to wherever the high ends up being, and then we're going to have a move back down to this channel line, this channel line right here. And then we'll get another move that'll last, maybe a couple of months into a high, and that should be the end of this whole little trend, right? This trend that started way back here in February. What is this? February the 8th. So once that's done, we should get a return all the way back to the February 8th lows, around 1800. And then what we're going to look for is a little ABC correction. And then if we get an ABC correction, we want to have our guard up and maybe step to the sidelines there. If we get an ABC correction and it looks like it's not going to make a new high, like it's not going to keep going, but it's going to roll over, then that's a good place to exit the market. And believe me, when we get there, I'll be talking about it. So it's not something we need to concern ourselves with right at the moment. I think if you're someone who's in the market, you look for this pullback to be done or nearly done, and then we got maybe 2 or 3 weeks up into a new high, slight new high around 2400. And then we'll get a larger pullback probably into this lower part of the channel line right in here, and then up and a new high up into this 2475, maybe even 2500. Maybe 2450, something like that. I mean, the highs are going to get smaller here. You're not going to see these big jumps like here, or like even this one right in here. You're not going to see that. All right, let's look at the 13-week Treasury. The Fed, actually, you know what? I don't even remember what the Fed did. I wasn't following it, but you can see short-term rates are really high. So if they didn't raise, they probably should have, because for the last 1, 2, 3, 4 weeks, interest rates have been taken off, short-term interest rates. And you can see when we first started talking about this, I don't know, we might have been, maybe it was in here, and I had this line and said, you know, if we break above this line, the Fed will raise rates. And of course, they did, somewhere right in here. And then we drew a new line here after we got a couple of tops. And I said, if we broke above this, the Fed would raise rates. And it broke up here, started trading here, and of course, they raised rates. And I apologize, I don't know if they raise rates. I mean, the Fed is really inconsequential in the interest rate market. I know it seems like they're very, very important, but a lot of that is they're there to they try to make themselves seem more important than they actually are. So the market is what drives interest rates, not the Fed. So the 30-year Treasury, I tell you what, we're going to look at that on a different. Well, I don't know. We can look at it here. Well, we'll look at the 10-year. The 10-year I think I'd rather look at because it's more important. So let's look at the 10-year real quick, TNX. And you can see that I've got the box is pretty wide here. I mean, you can see that we didn't make a new high here. We made, I don't know, is that a higher high? I'm not, let's see here. Might have been slightly higher. That high there is 26.21. This high here is 26.15. This high here, well, those are the same, 26.15. Wow, that's unusual. So we got some sort of truncated high here. But we should see the market pull back into this box. Now, I think it's at least going to fill the gap, but it could go down even to the bottom of this box, I think, before we get the next leg up. And that next leg up is likely to be a real doozy. So make sure that as this pulls back, you're getting out of your bond funds, you know, right around 2%. You can wait until you get to this 2.1%, maybe even 2%, but don't get greedy. Get out of your bond funds in this area. Maybe it pulls back a little further. I wouldn't count on it. Okay, I just wouldn't count on it. So somewhere in this blue box is where you want to start exiting your bond fund positions. Unless you actually, now I'm talking about bond funds. So that's like a mutual fund that contains bonds. If you have actual bonds and you have them spread out over a number of years, like you have you got a 1-year bond, a 3-year bond, a 5-year bond, a 10-year bond, it's okay to have those as long as you hold them to maturity, and then when you roll them over, you roll out a new bond. So for example, let's say you have a 5-year horizon on bonds. So you've got ones, maybe you got a 3-month, you got a 1-year, a 2-year, a 3-year, and a 5-year, okay? Well, when the 1-year matures, you go buy 5-year, let's say, okay? And then you wait for or let's say you have a 3-month. The 3-month matures, you go buy a 5-year. When the 1-year matures, you go buy another 5-year. And then the 2-year matures and you go buy a 5-year. Now the 5-year is now 2 years older. It's 3 years till maturity. And so on and so forth. That's called laddering bonds. And that's okay to do because regardless of what interest rates will be, you will make the face value of the bond back. And in the meantime, you get a yield. So, but bond funds don't work that way. Because there is no termination date or maturity date. So the fund acts in perpetuity. So if the fund loses money, your mutual fund loses money. The fund makes money, your mutual fund makes money. So there is no, they may or may not hold those bonds to maturity. So there's no way to actually manage the bond fund for a gain in a rising interest rate environment. I hope that's clear. If anybody has any questions, just comment, put a comment, ask your question, and I'll try to do a better job of explaining when we're one-on-one if that's something you're interested in. Okay, so that's the 10-year. Let's look at volatility. Volatility is still very, very low. Very low. I mean, this is low, low, low for volatility. So, until the market starts going down, volatility is going to stay low like this. So you might not see volatility jump in a significant way until we get to that greater pullback that takes us to the lower side of the channel. And then we might get volatility all the way, maybe back up in here. We'll see. Let's see. Euro, we're going to look at a minute. Let's look at our countries. Germany. You can see Germany's grinding its way higher. If you're in Germany, I say stay in it. Try to make a play to this area. If it starts to roll over and make a lower low, get out quick, because it could mean that this is the top. So sometimes, these markets, the way they top, it's kind of a rounded looking top, let's say. So you get this kind of, rounded top like this, or that's not a very good. I didn't do very good. More like that. Okay, so it's just the topping process is more rounded looking. And that could be what you have here. If you start seeing black candles, you start seeing a couple lower lows and lower highs, sell Germany. Japan, I think, is going to make it to the box. It's been grinding its way up there for a while now. We had this whole high here, then we broke out of this downward channel. Japan should finish somewhere in here and then roll over and go lower. United Kingdom to me looks weaker. It still broke the downtrend line, but it looks much weaker. So it's more like Germany. Just wait and see if it looks like if it starts making lower highs and lower lows, then sell your Germany position. That's really it for those. Let's switch over to toss charts and look at the dollar. Well, it's trying to get the dollar chart. Fortunately, it's not loading very quickly. And maybe not at all. Not sure why that's taking so long. Maybe we look at the euro first. So the euro, we've got this area here that looks like the euro is going to retest, which it's kind of already doing right now. The euro is live right now. It's actually trading. You can see it gapped up and ran up, and expecting it to finish kind of in this zone. Maybe could get a throwover type of scenario where you get a candle that looks kind of like so, and you get kind of a longer tail like a spike, and then you would look for the next candle being like that. So the euro, if the euro is going up, that means the dollar still got some potentially means the dollar still got some lower price action to print, and still we have no dollar, so I guess we're just not going to be looking at the dollar tonight. I wonder if there's any other, I'm trying to think if I have any other currencies I want to look at. We could look at the British pound, Japanese yen. You can see we have this long pullback. We've got kind of a correction going on right now, so I'm looking for the Great British Pound, JPY, uh, once it finishes pulling back. So it's probably going to pull back into this area. And then once it's finished pulling back, we should see it rise here. And this would be an A, B, whoops, well, that's horrible looking. A, B, C, counter trend rally. And then we should see this market roll over and then go lower. The next couple of years, maybe even 3 years, is going to see some crazy stuff going on in currencies. You know, just as a reminder, anytime you're trading one of these pairs, like the euro US dollar, the EUR/USD, this is the forex market, and it's an unregulated market. So you got to really what that means. See if I can explain it real quick. Essentially, what happens in a regulated market like our S&P 500 or the Nasdaq or the Dow is you have exchanges. So all the price action happens on a central exchange somewhere, and brokers are tied into the data feeds from the exchange. What happens in forex is you have maybe there's hundreds maybe of little mini forex markets trading. Kind of think of it like a bunch of different brokers who are trading the forex market, but then there's this larger overriding market. So you could be trading, let's say, on like I trade on Thinkorswim, right? So all the people that are using Thinkorswim are trading on the forex market, and then there's a larger forex market that they have to what's the word? Clear with. So there's a clearing that happens on a larger scale, much larger scale than what's happening on Thinkorswim. So the price doesn't necessarily, it normally reflects what's going on, but that doesn't mean that there aren't times when the broker that's Thinkorswim, for example, could take out my stop and then turn around and go lower. So let's say I was trading. Let me go to the euro, back to the euro US dollar. So for example, let's say that I wanted to take a position right here, a short position in the euro US dollar. Okay. So if I want to take a short position right here in the euro US dollar, let's say I'm in right here and it starts to go down. Okay. But there are other traders trading this brokerage. So maybe I'm right on the direction of the trend, but in the interim I get a little spike and then it trades back down and starts going down. Okay, so I'm right, but if I had a stop just above here, like right in here, well then my stop would have been taken out and then the market reverses down. And this kind of stuff doesn't really happen on the stock exchanges if you place your stops properly. But it happens a lot on the forex market, and a lot of it is because you've got these sub markets that are trading off of. There is no central exchange, so there's a global market, but then there's all these hundreds of little brokerage type markets, and all the traders that are on those markets could be taking advantage of you. So you just got to be careful when you're trading forex. But right now it looks like the euro is rallying a little bit, about 0.5%. So we'll see what it does in the morning, the market, or see what it does at midnight. If you really want to know what's going on in Europe, about midnight is when you want to look at this market, because that's when it's open over in Europe. All right, the one thing I wanted to show you, I wanted to switch to NinjaTrader and look at the ES. Most of you know that I mention Elliott Wave from time to time, and this is a trading software that I use called MT Predictor. Now it doesn't track Elliott Waves. That's not really what it does, but you can click on it and see if there's a pattern, right? So what it sees here is it sees this 1, 2, 3, of course, there's going to be a 4 and then a 5, okay? So really what's happening here is you've got 1 of a very large degree, 2, okay? So your larger degree 2, here's your larger degree 1, larger degree 2, and then this is all 3. This 1, 2, 3, 4, 5 is all 3, and then you have a bigger 4, and then you have your final 5. So what I'm expecting to happen here is, again, this to rally up a little higher. So if you look at it closely, let's zoom in a little bit. Let's just kind of draw it out here just to see, to show what we're expecting. This is about right, okay, for this little pullback. So you got, in here you got a 1, 2, 3, 4, and then we got to have 5, right? So let's say this is your little pullback in here. You got an ABC pullback. Okay, well then what I'm expecting is to make a new high right into this area, not much higher than this old high. And then we should get a pretty good ABC pullback, something like this. I mean, this is just what I'm expecting. This doesn't mean it's true, like it's got to happen this way, but this is a very plausible outline for the market. And then, of course, you'd have a new 1, 2, 3, 4, and 5 up. So I'm just going to draw that as one line. So then we have a new rally to a new high going like that. So the market should look something like this. We've already had this pullback, so we should either Monday or I would say by Wednesday next week we should be rallying in this wave, and then probably the following week, maybe the week after, we should start pulling back in this wave, and then this whole thing here could take, provided it does like this, it could be a triangle, could present itself as a triangle. So let's see what that would look like. A triangle would look more like this. And then a rally to a new high like so. So that's a triangle. The reason they call it a triangle is because you've got the price consolidates on both sides of the price action, and then it takes off. So it could be a triangle, or we could get a pullback into this area. A triangle will take longer. Pullback in this area will not take as long. I would say if I had a probability, and this is just a guess, I would say we have about a 60-65% chance of a triangle, and maybe only a 30 to 35% chance of a regular ABC pullback. Okay, so that's why I wanted to show you this on NinjaTrader. It's just easier to see the pivots on NinjaTrader than it is inside MT Predictor than it is on Thinkorswim. What did we not? We weren't able to look at the dollar, and I don't have a dollar chart up here, but I do have gold. You can see gold. Pretty good pullback in gold, but it looks like obviously it's done, and it looks like we're rallying in gold, probably in some sort of wave 3. This might be 1, 2, and then we've got a big 3 coming. So if you want to know like a good target, we could say we could pick out what the wave 3 is. And we could say, if this is the start of 1, this is the end of 1, right here, and this is the end of 2, we can look at an estimate for wave 3, and you can see it's way up here at 1650. So if this is if we're starting a wave 3, it should finish up around here, around 1650 or so. Now it could be that we have a little bit more pullback to go. So again, we don't have our ABC yet. So if you're thinking about trading gold, or you're thinking about getting into gold, you might just wait and see if you see we've already kind of had like a little A here, and this looks like this is B. Now if it doesn't make a new high, then we would expect the pullback to end right in here somewhere, and then wave 3 to move up there to the 1650 area. I hope that's helpful. When I show you the wave, there's no doubt that the market follows this kind of wave structure. What's always difficult about the wave structure is knowing, exactly which wave you're in and what degree. Like if it's a small degree, Like these are all little small degree chops, these little A, B, C's in here. But if you look at if we go back and look at the ES, and I look at it on a very let's say I'm on a weekly. I guess weekly is about as good as I can do. Yeah, it's not very revealing here, but trust me, that's the way the market moves. It moves in these little zigzag patterns, and I guess nobody really knows why it moves that way, but there's certain theories out there. The other reason I don't think 3 is finished here is, and this is something that Steve Griffiths teaches, and it's this little area right down here. I'm looking at this area right here. He has this little strength band, and he just calls it the strength band. There's a lower bound and an upper bound. But see how these bars are outside the band? That usually means there's a little bit more strength left in the market. And so that likely means that this wave 3 is not complete, and that we should see a move. And not only that, but it hasn't touched the wave 3 box, so we should expect that to go into that area before this whole move is over. So if you're selling options, wait a little bit to sell some calls. If you're like in an SPY, if you're bullish in stock, then you want to wait and sell your calls once the market starts to roll over, and then sell your calls slightly out of the money, and then try to buy them back at the lows. Hopefully that makes sense. Again, I'm getting off into a tangent. I wasn't planning on doing that tonight, but let's say you bought the SPY right here, and it's meandering its way up, and then it starts to roll over right here. Well, then you would sell your call out of the money right up here. Okay, as this pulls back, so here you sold your call. Okay, and as it pulls back and starts to break out, maybe right here, then you buy your call back, and two things will have happened. Some premium will have come out of it because it took all this time, and then also it's lower price, right? So the price is lower here than it was here, so the call will have lost value. So you're selling it at a high price, and you're buying it back at a lower price to close out your position. That's called selling covered calls. And then you're in the SPY as it meanders up, and then somewhere in here, maybe not until here, you sell an out of the money call right in here. It pulls back. Now, if it pulls back a little further, you can buy it back down here, so on and so forth, before it rallies into a new high like that. Anyway, that's something that people with a lot of stock do to earn income. It's a great way to earn income, but it's a little bit advanced. Maybe not. Maybe you're a well advanced trader and you understand that. But it's a great, if you learn it. Even if you're someone who likes to buy and hold, you can take a 6 or 8% annual return every year and turn it into 15%, maybe more, maybe 20% annual return. So it can really make a lot more money for you. So if you're interested in that, just Google covered calls. There's a lot of stuff online you can learn about it. And if you want to know more about it here, just again write a comment and we can talk more about it here. The bond market, again, this is notes. So this is the 10-year note, and we've had a pretty good pullback here in notes. Probably going to get some sort of rally. Looks like it's not finished yet. So maybe the rally, and it could be more complicated. We could get something, it could be something as simple as this, and then boom. Or it could be a little bit more complicated. It could be something like this, and then a pullback like maybe down to here, and then another rally higher, and then this. So these are the types of different. I know you're looking at it going, how does he know? I mean, notice that this low right here is slightly below this low. That's on purpose. This high right here is slightly above this high. Again, that's on purpose. And then this high is above this high. That's on purpose. And then boom, down. That means this would be like a wave 1 down. And then this would be, all this would be 2 right here. 2. And then this right here would be 3 down. Okay, so that's what I'm looking at. And that might just be the first, let's say the intermediate level of that move down. And then maybe you have multiple degrees of trend down. So maybe the down move is a primary degree, what Elliott called a primary degree trend down, which could take a year or more to complete. So anyway, that's why I say there's a lot. If you look at bonds over the really long term, and we can do that. We can go and look at, we'll do that real quick. Look at the TNX. Go back to the TNX. It's the 10-year yield. And let's just look at all data. So it's going to take a second here. Okay, so you can see, well, you can't really see here before 1962, but this cycle from high to low on bonds is about a 35-year cycle. So if you look at the high, the last high was the last major high was in, when is that? October 1981 was this point right here. So 81 to 2000 would be 19 years. And then 2000 to, say, 2018 is 18 years. So 18 and 19, that's 37. So we're due, okay? A 35-year cycle, we're already, let's say, a year or a year and a half over the 35-year cycle. So that's another reason why I think this low here is the low. Of course, it just barely took out the 2012 low. Broke this downtrend pretty decisively, and we're moving higher. So this little move right here should at least go. It shouldn't even stop really until we get to here. This is the pivot. You see the pivot here. There's a move here, and then there's a down move here, and this right here, this area here is called the pivot. And you can see if we made a decision space above the pivot, it would be right in this area. So interest rates, 10-year interest rates are going to 3.3 or so, which means if you start buying a house here at this point, it's going to be, like a 5.5% mortgage. Then we should get some sort of pullback, minor pullback, I guess, and then rally even higher. So hopefully that makes sense. This whole pivot to pivot discussion makes sense. If not, tell me it doesn't make sense and we'll talk more about it. All right, everybody, that is it for this week's Middle Class Investor. Next week, I'm going to show you a couple charts, I think, from Elliott Wave that I think are very telling, very important. Some really long-term charts and some bond market charts and just whatever I can find that I think would be useful for this discussion here. Okay? All right, everybody. Thanks for coming in this week, and we'll see you next week on Middle Class Investor. Take care, everybody. Bye-bye.